All right, well, it's 12:02. Today's session is being recorded, so let's go ahead and get started. I'm Cleo Aquino, and welcome to the Southside Builders Association Wednesday Lunch Bites, where we talk about trends and insights in the real estate field. Today's featured guest is a panel discussion about private money, so it is going to be a great one. Very excited to have Jose Baeza. He is the owner and founder at Efunding Experts. And he's also joined by Brandon Moulton, who is the Senior Vice President at...
Darren and XM.
Oh, hold on here.
Renovo Financial.
Renovo Financial. So sorry, Brandon. I was
she was muting somebody, Brandon,
yeah.
as she was doing your intro.
That's right. Wanted to make sure everybody knew you were in the room, Brandon. That's what it was.
Okay. Dramatic pause.
Yes. Okay. I'd also like to take this time to introduce my co-hosts, SBA board members Lori Wyatt from Real Estate Growth Partners, Stan Bachnowski from Lakeside Bank, Jerry Brown from Siegel and Callahan, Bob Dickinson from Greater Illinois Title Company, and Michael Hobbs from Peru Appraisal Consultancy. I'd like to give a really big thank you to Bob Dickinson and Michael Hobbs for bringing our guest speakers for today. So thank you both very much. Yay, right? Big clap. Lastly, SBA Board President, Mr. Andy Skolnick. During today's segment, we trust that our colleagues will continue to mute themselves, and please use the chat box if you have any questions during today's panel. All right, now with that said, let's get to the good stuff. I'm going to turn it over to our board member and moderator for today, Michael Hobbs.
Hey, thanks, Cleo, and thanks everybody for being here today. Really excited to once again have our annual private lending panel. Of course, this year we're doing it virtual, but no less desire to bring significant ideas and opportunities to help you expand your impact, your influence, and ultimately your results. So today we're really excited to have Brandon over at Renovo and Jose over at Efunding Experts. For some of you, you're like, hey, maybe I know Jose or maybe I know Brandon, but I really invite you to bring a new listening today from the perspective of what could I learn? Is there one takeaway that I could pick up here that would increase either the next likelihood of success in upcoming transaction, or is there a way to increase my ability to either get the deal done faster or more profitably through the expansion of potentially who you're working with, or maybe you increase just the velocity that you're engaged in. So with that, we always like to start out with a little bit of an introduction. So Brandon, if you want to jump in, share a little bit maybe about yourself, be helpful. I don't know if everyone knows a little bit about you, and then if you want to share a little bit about Renovo.
Sure. So I started my career as a commercial underwriter with Metropolitan Capital Bank. I was there about 7-8 years, right out of college, did that thing, really cut my teeth as an underwriter, and then moved over to Renovo about 5 years ago and became an originator. So I'm focused on originating single family to 50-unit apartment buildings and everything in between as a value-add construction deal. That includes new construction as well. And then also we have the capability to provide term debt in the form of 5, 7, 10-year ARMs and 30-year fixed options. So local lender, value add, and then a large network here of great folks that we've been able to cultivate over the years.
Thanks, Brandon. Really appreciate it. And Jose, how about a little bit of your background as well as a little bit about your firm, Efunding Experts?
Absolutely. So thank you guys for having me here. And yeah, definitely, I want to go ahead and share a little bit about myself. So I've been in the business and funding and lending to entrepreneurs for about 8 years. I started off lending cash advances, but as many of you guys may know, those things can be very expensive and they don't typically work well with real estate. So what we've done over the last 8 years is we build a Rolodex of different types of lenders and different lending options that have helped a lot of our entrepreneurs, that have helped a lot of our clients get access to the capital needed. So when we get our clients that are typically real estate investors, although we do get some restaurants and all types of business owners, but primarily real estate investors, we look at the overall picture as to what is it that they're looking for. Are they looking for rehab money? Are they looking to acquire the down payment money? And we put them and match them together with our lending options, which are primarily term loans and lines of credit for real estate investing. And we're able to get them access to as much as $350,000 on average within 3 to 5 business days in cash. And that allows them to do whatever they need to do. There are other options that we offer, such as hard money loans. We do collateralized-based lending, but we want to stick to our main business term loans and lines of credit because that's easier for a lot of business owners today's market with COVID going on. And yeah, I'm really glad that I have you guys here so that I can share more about what we do, and we'll go from there.
Thanks so much, guys. I think it'd be helpful. Some of you all may know, again, Brandon, you may know Jose, but with the expansion of so much additional credit available outside of the traditional banking space, it really has been a transformative experience over the last 10 years when you think about the speed of execution and the evolution, if you will, of private money. Whereas it used to be maybe someone, the running joke used to be like, hey, my friend Vito driving up in an automobile with a briefcase full of money is no longer the case. When you look at the technology, the professionalism, and the consistency with which a number of these firms have come to market and are really supporting real estate entrepreneurs, it has been a transformative experience. I think even, Brandon works at Renovo. That was founded by Kevin Werner. He and his brother were previously in a business that supported a lot of real estate entrepreneurs. When you look at that evolution of technology and where it's at today, it's just a different game. Maybe Brandon, if you want to share a little bit about the back office processing and really what has built Renovo, because I'm not sure everyone really understands what a fintech business Renovo is.
Yeah, sure. So it's definitely quite a change from, the back in the days of, meeting Uncle Guido for, a flexible loan, we'll put it that way. 5 years ago, the industry was really solidified and legitimized, I think, by Goldman Sachs stepping into the arena and purchasing a large private money group out of California. And since then, really, Wall Street's gotten behind the idea, right? And it's also been a great tool for, I think, a lot of investors to take their business to the next level. Maybe sometimes experience doesn't match. Maybe they're looking for down payment flexibility or real world underwriting. But, all those things being said, there's some great capabilities and reasons to use Renovo type lenders. So with a local market knowledge and kind of a community bank feel, if you will. So we're focused on guys that have a very focused business plan and getting behind them for the long haul, so that we can really help them take it from 10 units to 100 units or whatever it might be. To Mike's point, it's definitely evolved, and you've also seen come in line with that as well, because there's a lot of players. So it's not the 20% loans of Uncle Guido back in the day. You're now seeing rates in the high single digits and a couple points, but there's definitely some reasons to use it and when not to use it. But anyways, I think there's definitely a back office and team to support your needs now.
Pardon me. Jose, you had mentioned with your background being an entrepreneur and being in a different segment of the funding business and kind of moving in this direction. Maybe if you could touch a little bit on the approach that you're bringing, really being an access to multiple sources, as opposed to Renovo, which has all its own funding and is a direct lender every time. Yeah. You're doing a lot more matching and a lot more connecting for opportunities. If you could share a little bit about that for everybody's benefit.
Yeah, for sure. So one of the biggest things that I've encountered as with our clientele is that we get businesses or business owners from all walks of life. We get the startup, we get the business that's been open for years and years. We get businesses that have been open for years but haven't been generating income. And we also get realtor or real estate investors that only have one property. So we get all types of different investors. and with all different types of experience. So what we've done is we first consult the client as to where they're at. Do they know about real estate investing? Are they an experienced real estate investor? And so ideally what we want to do is we want to create a process that's going to help them. So for someone that's looking to acquire, like say a property, they're going to need down payment money. Down payment money so they can purchase that property and they can acquire it. Then they can go ahead and get a loan from, whether it be a hard money loan or a private money loan. And so what happens is that, I'll give you a perfect example. I have a gentleman that we just finished processing his file, and we just raised $220,000. Okay, we did it in less than 2 weeks. $220,000 in cash, right? So that's a little bit scary for someone that has no experience in real estate. Now with this gentleman, he's a teacher. He's an elementary school teacher. He has a son, and he's doing it for his son, right? He's doing it to build the legacy, to build the network, so he can generate more income. And then that way, when his son is in school or in high school, he won't have to work anymore, and he can just simply take care of him. So having said that, with this particular individual, he has no experience in real estate. He has a good amount of income. It's not like the greatest because he's a teacher here in Chicago, but you know, he has some sort of experience. He only has one property that he's done before, but now with $220,000 in cash that he has available, now he'll have access to way more access to properties. We do have we have several partners that are in the hard money lending side of things. So with $220,000, that's a lot of down payment money. And sometimes some of these lenders might request 20%, 30%, 10% for a property that, let's say it's $100,000, right, in the Chicagoland area. And even if it's requiring 20%, which is $20,000, he'll have more than enough money to go ahead and start purchasing properties. And that's really what we focus on. We focus on the entrepreneur. What are their needs? And everybody is different. And the thing is that we use a lot of different lenders, even like, you know, companies like, let's say in this case, Brandon, where he has his own rates. This isn't a one size fits all. Everybody's in a different position, and it's our job to see where you're at, whether it be through credit, right? Because sometimes we also don't have, or sometimes like our clients don't have the perfect credit, but we want to go ahead and figure out what's the best match for them. So with this particular client, 220,000, well, it's only the beginning because he doesn't know what to do with that money. So guess what? We help him and we match him with several lenders. We've already given him the proof of funds for hard money loans. So now it's time to take it to the next step and acquire more properties. But for those of you guys that are out there and that do know what to do with $220,000, then, you know, it's pretty much just a given at that point because you know what to do with it.
Thanks, Jose. So Brandon, I think maybe if you can take a step back, I know most of the people I recognize, most of the faces are experienced real estate investors, but you used to work at Metropolitan Bank Group. You're familiar with a bit more of that experience as opposed to where you're at now with Renovo. Could you touch a little bit on the benefit of a private lender versus a traditional lender?
Absolutely. So I think there's really three primary reasons to use a private lender. One is flexibility within the underwriting or capital stack. Oftentimes there's only so many 20% or 30% you can throw down. So folks are looking for between 10 to 20% down when coming to us. Two, within that flexibility, you're oftentimes eliminating the need for partners. So I'm sure we all can relate to having done a deal where we raised capital, we rehabbed it, we leased it, and now we've got to pay our uncle 50% for the rest of our life for as long as we're in that deal. After about 6 months, that gets real old because it's hard to find deals. It's hard to, you know, a battle with the city to go through construction, et cetera. So oftentimes that's the primary driver. Speed. I would say speed is the next. Oftentimes, to win these deals, you've got to go to a seller and say, look, I can close in 2 or 3 weeks. And that usually gets them to move in your direction. So really speed, down payment, and then I'd say the last piece is the real world underwriting. Banks are going to get focused and locked in on ratios and DTI, where we're looking at these deals from a 9 to 18-month window. So, those things there's other mitigating factors that go into it, whether it's cash, experience, et cetera. So we've got some ability to look beyond that. That's the primary drivers. Yeah.
Excellent. And Brandon, you mentioned you threw in a couple acronyms in there. If you would, for a couple of our attendees' benefits that may not be as familiar with it, what is DTI and why does it matter?
Debt to income ratio. So banks are going to look at your top line in terms of what your taxes show you for income, and then what your credit report and outstanding debts are monthly. And when you get beyond really a 40%-ish, 45%-ish ratio there, that's when they start to ask quite a few questions, et cetera. So very important ratio, and always highly scrutinized.
And in the private lending space, why is DTI not, I would say, I can't say it's not paid attention to, but it's really not the concern. I mean, I'm kind of leading with.
We're looking at the asset primarily.
Exactly.
And want to see the performance of the asset, carry not only the loan, but be able to exit sufficiently to carry our debt and either be solid for a sale or a refi.
Yep. Very good. And then Jose, if you haven't already, please put your contact information in the chat as well. I know David had asked for it. But Jose, with a number of the clients you work with, because of the approach you're taking, which is heavily within real estate, but also with more from an ownership standpoint, what are you focused on primarily when people are looking to you for private money opportunities?
Absolutely. So, one thing that Brandon touched upon, which we also look at, is the debt to income ratio and the debt to credit ratio. Okay. So a couple things is that number one is people's credit is important, more important than it used to be, right? Because right now with COVID happening, that's pretty much all you have right now. It's your credit score. Many businesses don't have any revenues for the last couple of months. Their revenues went down. Perhaps maybe some real estate investors, they took also a toll because of of people not paying their rents. So everybody took a hit somehow. So the way that we look at is we look at the credit report first of all. We don't do a hard pull. That's the number one thing. We don't recommend doing a hard pull on our end. We don't even do a hard pull for to see whether or not somebody would qualify. The first thing that we look at is their credit report that they have to pull, because that way it doesn't become a hard pull and it doesn't affect their score. So we look at a couple of things. We look at their credit score, all right? An ideal credit score, we would like to see a minimum of a 680 FICO score. It's not because it's everything, but rather that anything below a 680, there's something going on, whether it be late payments, collections, maybe a bankruptcy, whatever it is. We like to see at least a 680, okay? Once we get to see that 680 FICO score, and then keep in mind, this is only for term loans and credit lines, because with hard money loans and some other loan offers that we have, there's the minimum credit score is around 600, but I'm gonna talk about term loans and credit lines specifically. 680, no open bankruptcies, no open tax liens. We would like to see a less than 40% debt to income ratio, all right? And no more than 30% debt to credit ratio. Now, there's always going to be an exception for all of these. Similar to what Brandon said, anything over 40, 45%, we're gonna have to see as to why the debt is that high. And when we look at somebody's report, we'll get to see all of the statistics on that particular report. So before even deciding to give you a quote, we'll know the pros and the cons on your credit report, and we'll go ahead and take a look at it and go over that with you so that if you do qualify, based on our experience, currently we have about 15 underwriters in-house. We have about 7 consultants that are dealing specifically with clients. And then we have over 350 affiliates that we work with. But most of our underwriting is done in-house. So we will take a look at your file and we will give you an estimate of how much money we believe that we can get you based on our resources, based on our experience. And once we go over that, you can decide as to whether or not to move forward or not. But the biggest thing is that for us, we don't want to add any inquiries. We want to make sure that we give you all of the pros, the cons, and we give you an estimate of how much money you can actually get before processing you at all, or before even pushing you in front of our client or before in front of our lenders. So, you know, the requirements are pretty easy. All I need is just a copy of the credit report. And again, the reason being is because it's going through our internal process before we even push it to our lenders.
Thanks, Jose. So one of the things you clearly hear the difference on is where Brandon is very much focused on an asset-based approach towards deal-by-deal approval and looking to build a relationship. It's quite different in Jose's space, where it is more of a focus on the individual based on some of the funding they're pulling together. With that in mind, Brandon, I know you get asked this question a lot, but we'll just kind of throw it out there for you. Over the last 90 days, what type of transactions are you guys seeing? Clearly, there's been an evolution and an increase in competitiveness in certain segments, but what are some of the things, maybe 2 or 3 examples that have come across your desk in the last, let's just say 90 days, so it gives you a bigger window than just say the last 2 weeks?
Oh man, that's seen quite a bit. You know, a few things that we've seen that probably speaks to this group. You know, we've seen some other private lenders actually pull out of maybe the South Side in particular. Maybe their funding on the back end is frozen, whatever the reason is. So we had some deals come across our plate that way. Seeing really pull back on LTV and requiring more in. So that's what, you know, probably is the initial driver of the conversation. And then we've seen a lot of banks actually stop funding on new construction, even mid-project. You know, they've just said, look, you get through this segment of the townhomes, that's fine. After that, we're out, and just get us out, refi us as fast as you can. Seen that quite a bit. But yeah, I mean, it's really been a lot of pressure from the banks and what their appetite is right now. They're trying to say no without saying no is kind of the feeling I've gotten in some instances, which, you know, I can't blame them, especially on some of these larger construction deals that maybe have a 2 to 3 year horizon. You know, those are often bigger than what we're looking for. On a single asset, we would be typically under 5 million. And then we'll do anything from your, you know, most straightforward $100,000 rehab in the south suburbs. But combination of that, and then on the term debt side, you know, the 30-year money.
So Brandon, I'm going to stop for a minute because you and I know this. I want you to take one step back and then dive into that. So most times people think of private lending. We have a lot of great members of the SBA, the Southside Builders Association, that are in the private lending space, primarily in the fix and flip. In recent years, Renovo's gotten into term lending. So you've expanded your offering. So with that as a setup now, could you share a little bit more where you were going?
Yeah, absolutely. So, you know, when we talked about, you know, Wall Street kind of legitimizing the industry, they've gone ahead and then also started to really focus on this 30-year paper as well. And who better to originate it than the private lenders that are doing the heavy lifting from the construction side. So on the takeouts, we're now offering 5, 7, and 10-year arms and then 30-year fixed money. And, you know, it's very competitive in terms of what they're willing to offer from a cash out perspective and LTV perspective. They will, after 6 months, no seasoning. So they'd go up to 75% LTV. Rates are in the mid 5s. So it's definitely a focus of theirs, and it's become, as a result, a focus of ours. So, what I'm really kind of, maybe I'm late to the game, maybe not, I don't know. But as you can see, the economy really focuses on what the Fed is willing to do. And Wall Street then just basically mimics that. And, as money gets cheap there or pulls back, it really affects what your ability as an investor able to do. So right now they're saying the floodgates are open in that regard. That's why you're seeing the opportunities there.
Excellent. Thanks, Brandon. I appreciate that. And then Jose, I think it's helpful, maybe you're able to differentiate and distinguish with the funding that you're bringing to clients. Is there a focus on timeline and duration of the credit facility?
So ideally, when it comes to the timeline and duration, is more when we focus on term loans and credit lines, especially when we're dealing with real estate investors, they're looking at the short term of things, right? So they're looking at a fix and flip that's going to last less than a year. They're looking at a particular loan that they're not thinking about keeping it for more than 2 years. But our process takes, or some of our loan offers, we do offer 3 years, 5 years, and 7 years. And that is very helpful for a real estate investor because everything's in the numbers, right? A deal makes sense. If the numbers make sense, then the deal is going to be good. So depending on what kind of deal you're looking at, we want to focus more on the overall, what's more important. Is the interest rate more important? Because if it is, then I would recommend doing something short-term where it's 3 years versus 7 years, right? If the monthly payment, let's say that you're doing a fix and flip and you want to keep your monthly payments as low as possible because you're going to get rid of it within 6 months anyway, then I would recommend doing a 7 year. 7 year terms, even though it may be more expensive on the interest rates, it's still going to be way less expensive based on what your plan is. If you're trying to get rid of it within 6 months, realistically, you're not really paying much interest anyway. And at the end of the day, we focus on that when it comes to the term loans. Credit lines don't expire on our end because we offer 2 types of credit lines. And we offer either a line of credit that is based on the revenues that the business is bringing, which is almost like a checking account. Or we also, and that's a business line of credit, by the way, or we also focus on credit cards, credit lines, all right? Those are a little bit more on the, let's get you processed as soon as possible. You can use it for rehab. You could use personal and business. And the credit cards, I only recommend them if you're going to be using them for like rehab money, only because you can't really put a down payment with a credit card. And, we get creative. If it is something where you want something long-term, then I would recommend doing a true line of credit. But in regards to that, the credit lines, they don't really expire. The only time that they would be forfeited, I guess, is if you misuse them, which I've seen several of our clients do. They accidentally either just without knowing, they'll go ahead and spend it somewhere where they're not supposed to. If it's a true line of credit.
Jose, that never happens. I can't believe you. I am shocked that you'd even mention that. That is so surprising.
So, and with the credit cards, that's another thing why some people decide to go and do a line of credit through a credit card, because those don't have limits on what you can use it for. We don't recommend you going on vacation, of course, but still. It's a little bit, when it comes to a true line of credit, that one's a little bit more stricter. But the term loans, like I said, is 5 years, 3, 5, and 7. 3, 5, and 7.
Excellent. Thanks, Jose. So, Brandon, I think one of the important things, especially when we look at it from a private lending standpoint, is the speed of execution. We want to talk a little bit about what someone who has not yet worked with Renovo or another private lender should in general expect, and then what specifically should they expect if they work with Renovo?
Wow. So, private lenders can mean a lot of things. Your buddy's dad could be a private lender, and in that case, they can close literally within a day. depending on what their requirements are for docs, et cetera. But putting the individual aside and focusing more on actual, groups and companies that do this on a larger scale, for us, we want to have a conversation up front, meet for an hour or so, just get to know your business plan, gather all your docs. Once I have your docs and I'm able to really pre-qualify you, from there, we like to issue a pre-approval so you can submit with offers. And depending on the asset, whether it's a single, call it 1 to 4, or a 5+ unit property, on 1 to 4s, we can close within 2 weeks or 10 business days. Now on 5+, it's a little bit different, typically 3 weeks, depending on how long it takes to turn around appraisals, et cetera. But certainly, both well within a month. So that's us. I would say, industry wide, it's probably pretty close, maybe up to a month, depending. Believe it or not, as excited sellers are to sell and say that they need to have a quick close, oftentimes we're waiting for them to get to the closing table with zoning certs and title, et cetera. So third parties, definitely are play a factor into it as well.
Thanks, Brandon. I appreciate it. And Jose, you had mentioned on average, what's a typical turnaround for someone taking a different approach, which is one that you all offer for getting funding? Oh, you're on mute, Jose.
All righty. So the process is very simple, okay? So it takes 24 hours for us to analyze your credit report. That's the first thing that we're going to request, a copy of your credit report. We don't want to do Credit Karma or any of those free credit reports, simply because keep in mind that if we're going to be helping you and we want to give you a quote that is as accurate as possible, so the first thing we'll request from you is a copy of your credit report. Once you send us over your credit report, typically within an hour or 2, but I always like to say 24 hours just because, things can happen. But within a couple of hours, you'll get a quote from us. You'll get a call from either myself or one of my consultants, and we'll go over your quote. Your quote, once we give you, let's say that it's 50 to 100,000. It's just as an example. If you like those numbers and you like what I have to say about that, then you'll go ahead and submit an application. We'll gather all the documents. And again, this is still within a day. And you can get access to these funds within 3 to 5 business days. It depends on how organized you are with your files, because sometimes we just need a copy of an ID, and we'll be waiting for days. Sometimes we need a copy of your tax returns, and if you haven't done your tax returns and the lender is requesting the tax returns, and that's going to take a little while. But if everything goes well, if you have all the documents in order, which is not a lot, by the way, it's a copy of your photo ID. Sometimes we require social security card, proof of address, tax returns, and if we're doing anything with your business, articles of incorporation and SS4 form. Now we'll go over that, once we give you the quote. But that's pretty much it, and that's something that is pretty common for all of us to have in our file folders or wherever you store your documents. But once that gets submitted, you'll get the offers within 2 days of us presenting the offers to our lenders, and depending on where you're going. And then you can get the money in 3 to 5 business days. Most of the money is given to you as a direct wire transfer. So that once you get approved, you'll get the money either the same day or the day afterwards or the next day. Very rarely do you ever get a check, although it has happened. But I mean, realistically, no more than 2 weeks. On a good deal, it should be less than that.
Appreciate it, Jose. So Brandon, because we have a wide range of experience here on our meeting today, and because you, like me, also have a banking background, could you touch a little bit on one of the benefits of working with a private lender? Because if we just think about someone who's acquiring properties using, say, a conventional lender, there's some very specific restrictions in the marketplace that come down from on high, and how that's not the case in the private lending space.
Yeah, so I would say for the newer investor, good luck going to a bank and asking for a construction loan. It's just not going to happen. I hate to break it to you. So, in those instances, we're looking to partner with folks that are successful in some other fields, right? And maybe looking to build, a portfolio and, have, some financial wherewithal and a plan, right? And where we can be, really a second set of eyes, and maybe you can leverage our network. That would be really the benefits to use us, right? And then for the more seasoned guys, it's really the flexibility and the down payment. I mean, just to cut to the chase, that's why they come to us. They know how to use us, when to use us, why to use us. And, we've gotten, had good success with all types of investors, but, and then I guess the guy in the middle that's trying to grow, right? They need some counseling, they need some of the network, but they need access to capital, right? And sometimes banks just aren't willing to take that bet, maybe on $1 million or $1.5 million, whatever it might be, when you're that mid-sized guy, right? So everybody's got their own reasons, but those are the common themes I see.
Yeah, thanks. I appreciate you touching on that, Brandon, because it does make a difference. And then Jose, as we kind of bring it around the corner, what type of properties are you typically finding your real estate clients investing in?
So the properties are pretty much all over the place, honestly, because we deal with all types of real estate investors, whether it's experienced or brand new. We are working with people that have no experience and they're just looking to acquire a fix and flip. We help people that are looking to do wholesale. And we also work with people that are looking for like new construction. Now those can be a little bit tricky, but like I said, our funding can go up to $350,000. So depending on how much money you actually need, you may be able to get away with it, but the funding that we offer has no limitations as to what you can use the money for. So once we provide access to the money, right, the cash, that cash goes straight into your bank account. And what you do with it at that point is between you and whomever is helping you, whether you're working with a consulting agency or your business partner, whatever it is. So, with us, we're more focused on getting you access to the money. It's not too much about the project or what you're going to do with it. We, of course, help you because we don't want you to make any mistakes, or at least try to limit the amount of mistakes that you make, because we have the experience and we also have the experts that help us with that. But having said that, if you need money for a construction loan, if you need money to fix a property that you're currently working on, and maybe there's already several loans on that property, we can help you. It's just a matter of whether you would qualify based on your income and or credit, because lines of credit is 100% on your, it's 100% based on your credit, or mostly based on your credit, unless we're doing a true line of credit, which then we have to look at your revenues. But then if we're doing a term loan, then we just need to look at your revenues and also your, your income and your credit. And once we provide access to the funding, again, it's all up to you. Whatever you're going to use it for, you can certainly use it for that. We even have certain clients that have used our funding for building or starting a cannabis business, which is very hard in the banking industry. But that only gives you an idea as to how flexible our loans are. And again, it's still 3 to 5 business days. I mean, imagine the gentleman I gave you guys an example on. He has no experience. He has very, very little experience in real estate, and he received $220,000 just on him alone. Not mentioning that we may be processing his wife in the next couple of days.
Got it. I appreciate you touching on that, Jose. So Brandon, we're getting ready to open it up to questions for others. Before I do that, one last question, and that is, are there any particular assets that you clearly steer away from at Renovo? Either asset types, situations, or maybe even potential prospective clients?
Well, the assets that we will fund are everything's the square footage on the asset has to be 50% or more residential.
Okay.
So we will do mixed use, but for the most part, it's single families and apartment buildings. In terms of borrowers or deals that we'll steer clear of, we are not a loan to own shop. We are not interested in rescue loans. That's just, for us, that's too much of a time suck. We're trying to work with folks that, you know, we can do more than one deal with, and there's a future with. So we have no interest in those Hail Mary calls.
That is helpful. What about new construction?
Absolutely.
All residential, mixed use?
We'll do mixed use, yeah, but you know, we're going to have to really hone in on the cash flow at this point and what percentage of the cash flow is derived from the retail space. Right now, I would say as an investor, you know, it's going to be tough to go to a bank with much mixed use, let alone anything more than 25% of the cash flow coming from the retail. Did I time out or did you guys?
I can still hear you.
Okay.
Welcome back, Brandon. Sorry
All
about that. My laptop decided to take a break.
That's okay.
Thank goodness for. With that, questions. One of which getting involved with other entities where there might be a larger capital stack. Is that something that you guys will look at, Brandon?
Wait, say that again. You're getting very robotic.
Sorry about that. Yeah, with properties that have a little more complex capital stack, such as buying from the city or getting involved, maybe if there's a piece of TIF funding involved, will Renovo take a look at those type of transactions?
We will, absolutely. We just closed on our first HUD deal. And that was more of a deed restriction than a capital stack, issue. But, the only hesitancy that I have around those is not for us, but as the investor, it's, do you want to be in a loan that's meant to be 12 to 18 months for potentially 36 months, right? And, our cost structure, call it what it is, in the high single digits is not going to be friendly, for the long-term haul, and having to go through gosh knows how many iterations of, applications or waiting for funds from the city, et cetera. So we've both got to just go into it eyes wide open to make sure it's a good fit.
Thanks, Brandon. And then Jose, you have alluded to this, but just for clarification for everybody that's joining us, that you'll pretty much allow people to use the funds as they desire on projects within the realm of approval for those that you've already communicated to. So are there any particular project types that are either off limits or are a non-starter?
You're on mute, man.
I'm on mute again? Or
No, Jose is.
Oh, Jose,
Right.
Thanks.
So there are certain projects that there's no particular projects that we won't do from a term loan and a line of credit standpoint, okay? Now, when it does come with, we do have, like I mentioned, we do have several other programs out there, and they do come with stipulations, such as the ones like with Brandon. We do have some other programs that are similar where we can't really, deal with construction loans or anything of that nature. But with the term loans and credit lines that we do have to offer, there's no limits as to what you can use the money. You can certainly use them for a rehab. You can use them for multiple projects. You can use them to acquire a property. In certain occasions, I'll give you an example. Depending on how much money it is that we give you, let's say that we give you $300,000, right? And you find a property for $150,000. Well, you can certainly purchase that property out in cash. And some of the strategies that some of those particular clients have done is where they purchase the property in cash for $150,000, they've gone ahead and refinanced that property. And now they have equity in that property and they take money out and now it's cheaper, and whether it be on interest rate or they just simply have access to more money. And that would be one way. Now, God forbid something happens to the loan, keep in mind that because the loans that we're providing and the capital that we're providing is not real estate based, it's uncollateralized. It has nothing to do with that piece of property that you're acquiring. So God forbid something happens, they're not going to go ahead and take that property away from you or do a foreclosure on it, because that property was purchased in cash, if that makes sense. So that's how flexible the program is.
Excellent. So with that, we've got a number of different possibilities. Brandon, are you guys also taking a refinancing position, or always just a primary funding?
You know, we'll do refis, purchases, strictly bridge, cash out refis, kind of the entire gamut. Absolutely.
Excellent. And then Jose, do you guys care if it's a first opportunity on a property or a refinance?
No, we don't care on that. Keep in mind that when it has to do with real estate, all we care about for us, our primary goal is to get you the money that you're looking for. Now, if you have a partnership with a lender, like say in this case it's Renewable, right? You've gotten pre-approved, everything's good. You need the 10 to 20%. Our goal is to get you that money that you're looking for, whether it be a little bit extra for rehab or to get you that 10% to 20%. So, you know, we work hand in hand with a lot of different private lenders, a lot of different hard money lenders, because we bring the aspect of 100% financing. You know, they'll bring in the 80%, we'll bring the remainder, and therefore nothing's coming out of pocket, if that makes sense. So it doesn't really matter to us. It's just a matter of what works for you.
Appreciate that, Jose. Cleo, I know that we always like to make time for just open Q&A. So if you've gotten any direct messages or anything, of course, that I may have overlooked at my switch between devices, if you want to pop those in, and we'll be opening it up to everyone just to, you know, pepper, as they say, pepper Brandon or Jose with questions. But Cleo, we'll go to you first, please.
Yeah, I think there's one question out here, and maybe you've touched upon it. What was your default rates? What have your default rates been in the past 10 months?
I can tell you right now, ours is 3.5% and declining.
Okay.
And for context, a traditional bank is 1 to 2%.
Nice.
Right. Jose?
Yes. So when it comes to all default rates, it's kind of up there because remember, we're not really pushing people through our process. We're pre-qualifying them. So I would say that our default rates don't really, I would say in the last 10 months, which keep in mind with COVID going on, it's in the near maybe 1%, if I had to really put a number to it.
Okay. All righty. There was another question out here and about what are the rates for your lines and credit cards or lines of credit?
You're on mute again, Jose.
So, all right. So the rates, when it comes to the interest rates themselves, because of COVID, they have gone down. It is largely based on the overall credit that you have. And the better the credit, the better the rates. With business line of credit, we can go anywhere from 0% for the first 6 months to 13 months. And then the way that, and then for the rates thereafter, it could be from as little as 2% and it can go as high as 15%. For the people that really qualify, that's where you're going more towards that 15% mark. Although right now it's been very rare. The most I've ever seen so far within the COVID period of time, it's I would say like 12%.
Okay.
Any others, Cleo?
That's pretty much it. Brandon, did you want to comment for that regarding rates?
Yeah, for us, I'll just give you the range, high single digits to low double digits on the rate. And then the origination fee is 1 to 3 points. And then for loan docs, closing, all that stuff, it's $1,500, and the rest is at cost.
All right, thank you. It looks like we've, between Michael and me, we've touched on a lot of the questions that were already in the chat box, if you will, so which is a good thing. Does anyone else out there have, you know, it's a cozy room of 49 people, so I will trust that you can go ahead and just unmute yourselves and maybe ask a direct question if you'd like.
I have a question.
Sure.
This is for Brandon. So, and I just want to understand, if I was looking for a commercial building, say a 8 flat, and I was able to get, you know, 75% of the loan funding from a traditional bank, could I get the other 25% from you guys? And then my second question is, what are the requirements on like reserves or personal reserves for your funding?
So for us, we do not finance gap funding. That's all. I think really what Jose primarily focuses on is the down payment money. All of our loans, we would have to be in first position. So that just wouldn't apply to us. But in terms of reserves, we're looking for a minimum of 6 months to carry your personal situation.
Thank you.
And Brandon, along those same lines, a quick question about, is there any minimum seasoning in order to refinance out?
So there's different triggers, but after 6 months, there is no seasoning. From months 4 to 6, they'll haircut you 5%. And then from months 1 to 3, they'll be at 80% of cost.
Got it. Thanks.
Yeah.
We have one question that just came through the chat. For individuals opening credit cards, how does that affect your credit? And secondly, how do these inquiries affect your credit profile?
Absolutely. So that's a really good question. All right. So the credit cards do affect your credit because overall, it's a good thing because you start lowering your debt, your income, your debt to credit ratio, which means that you don't have as much debt as you do credit, right? So once you have these particular credit cards open, keep in mind that your credit limits will be higher, and therefore your score is going to be a lot better because from the lender's perspective, they're going to say, oh, well, this particular individual has $50,000 in credit and they've only used $5,000, right? So that's a good thing. The only negative thing about that is that we all have to start somewhere, right? So when you're opening up those credit cards, there are inquiries, hard inquiries that go into your account. And that's the reason why we focus on getting you access to the money first, but first seeing whether or not you qualify, because we do not want to do any hard inquiries unless we know for a fact that you'll get qualified. So for us, we ask that you provide us with your credit report, because at that point, we'll see what the options are prior to doing any hard pulls. And if you like the offer, like say we give you, we say, you know, we can get you $50,000 or let's say $100,000, and that's what you're looking for, then at that point, it would be worth it because you're getting the access to the money. And yes, there will be inquiries, but at least you'll know what you're getting yourself into prior to just inquiring. Because I'm sure we have all experience where we're online, we get that little offer that says, hey, you've been pre-qualified for $50,000, only to find out that, hey, we're going to send you a mail in the letter, or we're going to send you a letter in the mail within 7 to 10 business days. And it's like, okay, so you just inquired my credit and yet you denied me. And at that point, you know, we don't want to get to that point. So we always make sure that we get you pre-qualified prior to doing anything of that nature. Now, there's another question, if you don't mind, Cleo, I can answer that as well.
Sure, of course, go ahead.
It says that is the credit line based on collateral? And the answer is no, it is not based on collateral. Most of our programs, the term loans and the credit lines is all uncollateralized. So you do not need to put down a mortgage or a home or properties, cars, nothing of that nature. Everything is just strictly based on your income and or your credit. So you don't have to put any collateral. Now there is a company fee, and that's something that when we look at the options that you have, it really depends on what program you're going for. I'll give you a couple of examples because, you know, I'll only take a couple of them. But the term loans and the credit lines, the term loans and the credit cards, those particular programs, we don't get paid from the lenders. So we, on those particular credit lines and term loans, we charge a one-time 15% success fee. So on $100,000, depending on how much money and what it is that you're trying to do, it's going to cost you $15,000 to acquire this uncollateralized line of credit or perhaps even a term loan. And when that happens, you have to look at the numbers because, again, if the numbers make sense, then that's why a lot of clients end up going through that process. If you're trying to do something where maybe the numbers are not making sense, maybe you're a little bit more on the tighter side with that particular deal, we do offer other programs, other credit lines like the true lines of credit that only charge 1 or 2 points and they put it in the loan itself. And so it really depends on what it is that you're trying to do and how soon do you need the money. If you needed the 20%, let's say that you only want $50,000, right? Well, you have to put the fee on the $50,000, which in this case, if it is $50,000, then it's $7,500 on the fee. So we would go after $60,000. And in that way, the same fee that we raise or the same money that we raise for you, it covers for our fee as well, if that makes sense. Now, at the end of the day, the flat fee, there is a question as to whether there is a percentage or a flat fee. The flat fee is only based on the hard money loans and also based on the actual, a true line of credit, because those, sometimes they do require certain licenses, so we don't get involved with that. We just simply take a cut from a commission from the lenders. But in terms of the term loans and the lines of credit, there is a fee only after you get access to the funding. So we do not charge anything upfront. We have no fees upfront.
Okay. All
Thanks,
right.
Jose. We're right about on the hour. If we have one last burning question, we want to take that in. Otherwise, we like to start on time and end on time. Does anyone have like a must-ask question before we bring it to closure? Going once, going twice. All right, back to you, Cleo. I'd like to first start out by saying, Brandon and Jose, thank you so much for being part of this and really just providing a deeper cut into the possibilities that are out there to really expand each and every one of our members and guests' opportunity as a real estate entrepreneur. And we look forward to significant success in the community. And Cleo.
Thank you so much for having me.
Thank you.
Yeah, thank you all. So our next SBA meeting is scheduled for Wednesday, October 21st. We have Ralph Martier. He is the Executive Director for the Center for Tax and Budget Accountability. So as you can all imagine, it's a very, very timely discussion as Illinois will vote on whether to execute a graduated income tax structure. So, you know, I think it'll be more than about talking tax brackets, okay? It'll be a very exciting discussion about taxes. Again, thank you all for being here today. Jose Baeza, Brandon Moulton, Michael Hobbs, Bob Dickinson, thank you very much for today's discussion. So everyone stay connected, stay safe, and we will see you in 2 weeks. Okay, good day, everyone.
Thank you, everyone.
Thank you very much. Have a great day.
Bye, thank you all.
Thank you.
Thanks, Brandon.